well. So it's a stimulatory but inflationary effect. And when the Fed raises rates trying to slow down the economy, they're also increasing the deficits, which pours out to the receivers of those interests. And so we kind of have this K-shaped economy situation where there's data point after data point showing that the bottom half of the population is really under pressure right now. Inflation has been a really big pressure on them. They're locked out of the home buying market. Sales at kind of lower income retailers are keep coming in poorly. Whereas on that upper half, and especially the top third or the top quartile, they've generally still been holding up pretty well, and it's just kind of the circular loop, and it just shows the somewhat ineffectiveness of the current policy regime.
In a recent interview on the Jay Martin Show, Lyn Alden discusses potential rate cuts, their current impact, possible scenarios, and the state of American debt. At the time of the interview, Bitcoin is trading around $57,000, with a 1% decrease in the past 24 hours and a 6% drop over the last week. Lyn Alden, a well-known macroeconomic analyst, provides valuable insights into the Federal Reserve's monetary policy decisions and their implications for the economy. She explores the likelihood of future rate cuts and how these decisions might impact various sectors, including housing and employment. Alden also examines the complexities of the American debt situation, offering her perspective on its sustainability and potential consequences.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
And so, I expect that we're probably going to see at least 25 basis points cut in September. They've rather firmly signaled that they're going to at least begin a rate cutting cycle. It's unclear how fast they're going to go. That's going to depend partially on what happens in the next couple quarters, economy-wise speaking. The argument that I made in that recent newsletter is that much like how the U.S. was rather desensitized to rising rates, it's not immune to rising rates, but it's rather desensitized to them, especially compared to many other economies, that I think would also be likely desensitized on the way down, which is not necessarily a good thing. And this is largely for a few reasons, primarily that the United States, the way that our housing financing works, consumers tend to lock in longer term mortgages compared to most other countries. It varies by country to country, but in general, most countries have less of a long-term fixed rate. And so when their central bank raises interest rates, it generally over a handful of years starts really trickling through the consumer base. Whereas in the United States, it's been really spotty, because if you don't own a home, if you don't have a lot of assets, then unfortunately you are kind of locked out of affordable home buying, right? That's a tangible issue with raising rates. But the majority of spending actually kind of comes from the top half of the population. And a lot of them are actually doing quite well, despite the fact that interest rates went up so much. And then even looking at the corporate sector, if you compare, say, the United States to Europe, corporations in the US get more of their debt financing from the bond market and tend to lock in these longer rates, whereas European companies, of course, they are active in the bond market, but they have a higher ratio of bank lending. And in the United States, it's really the smaller businesses that are reliant on bank lending. So that means shorter term loans, more rate sensitive. And so when they cut rates, what makes this cycle somewhat different is that we're less likely to get a lower low in interest rates. So over the past 40 years, one of the most powerful aspects of cutting rates, especially by a meaningful degree, is we get a lower low, both generally in short-term and long-term rates. And then that allows a lot of homeowners to refinance their mortgages, which is kind of a free lunch. If interest rates go down enough, they refinance and they have lower monthly payments going forward. So they get more nominal spending power. And that's been a cycle that's repeated over and over again. There was a huge refinancing cycle, in 2020 and 2021. And if they cut rates by 50 basis points, 100 basis points, even 200 or 300 basis points, it's not necessarily a lower low in interest rates. This was the first higher high in like 4 decades for interest rates. And I think the thing we have to see next is if we do indeed get like a higher low, there's kind of marginal refinancing. So people that were unlucky enough to, take out a mortgage in 2022 or 2023, which was actually pretty low volumes, they'll be in a position to refinance. and there'll be some stimulus from that. And some of the more troubled areas, maybe certain marginal commercial real estate or certain small businesses that are kind of struggling, they'll get some benefit out of those lower rates. But the big chunks of where debt is, a lot of that's fixed at lower rates than they are now. So I think it'll be less stimulative.
As we just heard, Lyn Alden discussed rate cuts and the sluggish housing market in the United States. She delves into the complexities of central banks and their role in shaping economic policies, stressing the crucial need for a reliable ledger in financial systems. Alden draws parallels between traditional banking and cryptocurrencies in this context. The conversation then shifts to the current state of the fiat dollar, with Alden providing her analysis on its strengths, weaknesses, and potential challenges in the global economic landscape. Now, let's continue to hear Lyn's insights on central bank systems, the importance of a dependable ledger, and the status of the fiat dollar.
We're in. I think we're in the early phases of finding solutions. And so the way I put it in the book is that fast transactions are an easier problem to solve than fast settlements, right? So if you have Morse code and telegraph, you can do fast transactions. Two people can talk across the Atlantic Ocean and agree on a transaction. And then the settlement is the hard and slow part, sending and verifying gold. Even in the modern era, when Germany repatriated its gold, they expected it to take like 7 years, and they were happy that it only took like 4 years, which is it's kind of a comical number, and it costs millions and millions of dollars worth of logistics and security and auditing and all these things. So settlements have been a problem. One of the things I cover in the book is that Bitcoin's interesting because it's kind of the first time where we invented fast settlement, which is to say that as long as the network remains reasonably decentralized, I can send you value, and within 10, 20, 30 minutes, your Bitcoin is confirmed on chain, and I have no way to pull that back. It's kind of final settled unless the majority of miners decide to start reversing transactions and things like that. And so that's kind of the first true possibility for finding that solution. But then, of course, it has to go through this very long process of being tested, right? So then people make thousands of other cryptocurrencies, and they say, well, can these do it better? Or can someone find a way to hack it? Or how can it be updated over time to be more efficient? And all these things kind of happen, and it's still a very small market. It's only $1 trillion plus market cap in global fiat money is something like 100 trillion. And so it's still this kind of early phase to see if that's actually going to be the solution. I think it's a very powerful solution, but it obviously takes time for the market to test it and adopt it. And so as long as we're still in this world where Bitcoin is small, fiat is big, we're still kind of in this weird limbo of, fast transactions, slow settlements. And one of the things you see is that both on an individual level and on a national level, they consider speed to be a variable. So a central bank holds treasuries in large part because they can liquidate them in any kind of business hours. They can just say, we want to sell the treasury and buy back our own currency. Whereas if they're holding gold, it's the logistics of saying, hey, we just want to sell, $10 billion worth of gold right now. It's hard to do logistically. And so they do hold it for a portion of their savings, the part they don't really plan to touch anytime soon, whereas they hold other assets that are faster. And for individuals, they start monetizing things like the S&P 500 or oceanfront real estate or lakefront real estate or fine art, right? There's these other monetary things that kind of compete with gold, even if they're not really money in the traditional sense. They're things that they become our primary store of value. They're more efficient. They are powerful. But a lot of people, especially in developed markets, forget that in developing markets, that's not always available. A middle-class person in Egypt can't easily buy the S&P 500, for example, and their local stock market does not have the same long-term store of value properties. And so in those markets, they gravitate toward physical dollars, ironically, or they gravitate toward physical gold. And these are still kind of stores of value in those societies. Right. So when we think of money, at the end of the day, it's kind of a ledger, right? In either the literal sense or the abstract sense. So, you mentioned barter, for example. An example I use in the book is that when I was a young engineer, we would often go out to lunch, like me and my coworkers would go out to lunch, and we kind of take turns driving And if someone at lunch doesn't have like enough cash on hand, back when people paid with cash more often, they would just say, "Hey, can you just cover this and I'll pay back tomorrow." Everybody kind of keeps track of this ledger of who's driving enough, who's not driving enough, who's who owes who money. A lot of things are just kind of solved by having this like mental ledger, this kind of informal mental ledger between us. And that's how a lot of hunter-gatherers do it as well. There's basically this kind of like family and kin type of arrangement. As things formalized, we started putting things into literal ledgers. And commodities also serve as kind of a nature-governed ledger. So if we, for example, trade around gold and silver coins with each other, we're using nature as a ledger. We're using the fact that nature has kind of this governing process on how hard is it to mine gold and silver? What do you have to do to get more of it? What are its properties? So we're kind of trusting nature that those properties are going to remain consistent. That sometimes is violated. Like in those other commodities, they were fairly consistent, but then new technology comes along and they can kind of cheat the ledger, at least compared to everyone else's technology. So far, gold and silver has been really resistant to that, which is why they're still monetary commodities. And so either whether trusting nature to run the ledger or trusting humans to run the ledger, we're in this environment where in order to not get our money diluted, we have to have some trust in the ledger that we're using. And in the modern fiat currency era, that's a trust that's commonly violated. So in Egypt, for example, I keep using Egypt because I live part of each year there. They've got over 20% structural money supply growth year over year. And so if you're holding Egyptian pounds, and many people still operate in a cash economy there, especially on the lower end of the income spectrum, it's not a heavily banked society. There's the middle class and up is generally banked. Some of them can earn interest on their bonds, things like that. A lot of the lower class is really just moving around cash, and they're storing cash as their savings. And this unit is getting diluted at 20% per year or more. And so they're kind of trusting a ledger that's getting kind of weaponized against them. And it's not as obvious as taxes. If you earn income and then you're told you have to pay X percent back, it's a very visible tax. Whereas if you're earning an income and you're getting 5 or 10% raises per year, but the money supply is growing by 20% per year, you're getting both your wages and your savings invisibly taxed because the ledger is being diluted against you. And then even as gold holders, you have to understand the properties of gold, which is that you're probably going to get diluted by 1.5% per year on average, which is obviously a much better figure than US dollars that get diluted at roughly 7% per year long-term on average, or emerging market currencies that on average get diluted in the double digits per year. And so understanding your expectations around dilution and understanding who controls the levers of those dilution. If the fiat currency, it only takes a small number of decision makers to really dilute your savings and your wages. Whereas something like gold, there's no central authority that can just decide there's going to be 10% more gold this year, right? It's this very decentralized process of miners going around exploring for it, permitting it, building the mine, putting a lot of energy and labor into it, refining the metal. It's a very expensive, time-consuming process, and so it's very hard to rapidly change that unless there's some amazing new technology to get gold off the sea floor or from an asteroid, or whatever could potentially maybe break that cycle. Still not really in the intermediate term to worry about. So it all comes down to what ledger are you trusting for your store of value and your what you denominate your contracts in. And then even on the international scale, if a Brazilian company and a South Korean company want to do some sort of trade with each other, it's quite possible that the Brazilian company doesn't trust South Korean currency. The South Korean company doesn't trust Brazilian currency, because if you denominate something in the other's currency, they can just print a lot more of it.
Yeah.
And so generally speaking, they go to a third party and they say, well, let's trust the United States currency. That's kind of what a global reserve currency is. It's kind of like the largest, most liquid, most sound, even though it's still being diluted. It's just saying that neither of these companies and their governments can kind of unilaterally shift the contract around. And what they have to rely on is the United States, with its little bit more checks and powers and longer track record of success, at least in the scope of a business contract term, that they kind of trust that ledger. So a lot of these decisions come down to what exactly do you trust to denominate your contracts in, including your wages, and then also to store value in.
Lyn Alden provided an in-depth analysis of the Federal Reserve's potential rate cuts, the state of the American economy, and the complexities of national debt. She offered valuable insights into the housing market, central banking systems, and the importance of reliable financial ledgers. We'd love to hear your thoughts on a few questions. How do you think potential rate cuts might impact your personal financial decisions over the coming year? Considering Alden's insights on the fiat dollar, what role do you envision cryptocurrencies playing in the future of global finance? For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.